Global markets are treading water this morning ahead of congressional testimonies from Fed Chair Jay Powell and US CPI numbers. Meanwhile in Australia, housing lending dropped unexpectedly in May, dragged down by a sopping wet New South Wales. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Economist Maddy Dunk explains why Western Australia is performing so well in ANZ's Stateometer report.
It's coming down to really strong housing price growth in WA at the moment. We know housing prices have been growing in most parts of the country, but it's been particularly strong in WA.
But first, in 5 and 5 with ANZ, markets are in a holding pattern ahead of US Fed Chair Jerome Powell's double testimony to Congress on Tuesday and Wednesday nights, and US June CPI on Thursday night. The yield on the US 10-year Treasury was flat at 4 a.m. Sydney-Melbourne time, while the 2-year was up 2 basis points. The S&P 500 up 0.1%, with traders waiting on the start of the earnings season. The US dollar index was up slightly. ANZ head of FX research, Marjabeen Zaman, says a softer inflation and labour market outlook should work to take pressure off the US dollar over the next few weeks.
We continue to expect the US dollar to decline from here. And again, with the jobs numbers that we got in the US on Friday, we continue to see more reasons for the Fed to seriously start to think about easing. We think the first rate cut will come in September this year. And again, both the disinflationary trends and the slowing job market, as we saw unemployment rate rise to 4.1% on Friday, kind of points to the fact that the Fed will likely ease sooner rather than later, and this should then play into the softer dollar view.
As of 4 a.m. Sydney-Melbourne time, the Aussie dollar was down 0.1% at 67.43 US cents, while the Kiwi was down 0.2% at 61.33 US cents. Number 2, a key driver for the New Zealand dollar this week will be Wednesday's monetary policy review by the Reserve Bank of New Zealand. While the OCR is expected to be held at 5.5%, Marjabeen says softer recent data and a shift towards policy easing should limit how much higher the Kiwi can go over the rest of the year.
New Zealand's economy still looks a little bit soft, and that has weighed on Kiwi dollar crosses. We saw that recently we saw the quarterly survey of business opinion for Q2 showing weakness in both economic and inflationary pressures, which kind of goes in sync with the contractionary PMIs in recent weeks. So again, this combined with the some disinflationary pulse that should at some point change the tone from the RBNZ, but that's something we're only looking at for next year. And so at the very least, near term, we continue to see Kiwi dollar limited in terms of how high it can go, and our year-end forecast points to about 62 on the Kiwi dollar.
Number 3, the euro and European stock markets were down slightly overnight as traders weighed up what a hung parliament in France could mean for markets. Marjabeen says the current situation is still holding markets up compared to expectations ahead of the vote.
The market was thinking of a coalition with the centrists and the far right. In the end, we've got more of a mix of everything with the heavier seats on the left side of things. But again, market reaction not as negative as we would have thought because no one party has had an absolute majority. So again, looks like there is going to be a little bit of a gridlock, and maybe that's the better of the two evils in terms of market reaction. And so euro is not really retreated as much as you would have thought.
Number 4, housing lending in Australia fell unexpectedly by 1.7% in May from April, after 3 consecutive months of growth. ANZ senior economist Blair Chapman says growth so far in calendar 2024 is solid at 8.6% and is still solid over the year at 18%.
So even though we got this pullback, it's still sort of strong over the year and strong comparable to the same period last year. So I don't think anyone's going to be too concerned about 1 month of housing lending pulling back.
Number 5. Blair says housing lending remained strong in Western Australia and Queensland, but Victoria was down, and New South Wales showed particular weakness for a surprising reason.
The surprising thing this month was a fair pullback in New South Wales, but it has been really wet on the East Coast, and that could potentially be dampening sales and housing lending in New South Wales and Victoria in particular.
Sydney's rainfall in 2024 has already passed its usual average for the full year and exceeds the entire amount of rain in Melbourne, Adelaide, Canberra, Perth and Hobart so far this year. That's caused many weekend sports ground closures and disruptions to community events. Blair Chapman there. Now, in our bonus deep dive interview, ANZ Economist Maddy Dunk tells my colleague Alex Tarrant how that strength in Western Australia's housing market has seen it top the ANZ Quarterly Stateometer once again.
So the number one place that stands out in this edition of the Stateometer is Western Australia. It continues to outperform the other states and territories in the country. And it's actually the only jurisdiction in Australia that is operating above its long-run average trend. And not only that, it also accelerated in Q1. So in contrast, we're seeing that all other states are operating at a level that is below their long-run average. And I think that reflects the environment we're in right now, where rate hikes are slowing economies, but they are working through different states and territories at various speeds. One other state that stood out was South Australia. We saw a sharp drop in the Stateometer index in South Australia, and it's now facing a slowdown. It's actually the first time that the Stateometer index moved below the long-run average trend for SA in more than 4 years. And I think that might just reflect the fact that SA is starting to catch up to the rest of Australia, and it's just been a little slower to move there.
What's really driving that growth in Western Australia?
I think first and foremost, it's coming down to really strong housing price growth in WA at the moment. We know housing prices have been growing in most parts of the country, but it's been particularly strong in WA. Housing prices are up 12% this year in Western Australia, and we're expecting that Perth housing prices will grow 20 to 21% this year. And it ultimately comes down to a supply-demand mismatch, where we're seeing that supply is very weak. If you look at listings, they're very low right now in Perth in particular. But on the flip side, migration is still strong, and we have seen that fall in the average household size, which is also contributing to additional demand as people spread out and want a bit more space.
You look at the state budgets in this edition of the Stateometer. Are there any sort of key themes across all the different states in terms of fiscal positions, debt positions?
Yeah, it's a great question. I think through 2024, the growing role of government has been a theme that we've been thinking more and more about, because government is playing an increasingly important role in supporting households right now who are finding that it's really tough. So in the recent state and territory budgets, we did see a range of cost of living measures in there to support households. Queensland, WA in particular, had reasonably strong utility rebates for households there that are on top of those from the federal government. And that is flowing through to different states and territories' fiscal positions. Most states and territories saw that their fiscal positions were downgraded in the recent budgets relative to what we were expecting late last year in those mid-year reviews.
Maddy Dunk there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, July the 9th. Catch you tomorrow with how markets reacted to Jay Powell's appearances before Congress. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.